We're going to talk about the U.S. economy right now because we are joined live in studio by the Fed Bank of Chicago. President Charles Evan is here to join us. In fact, he's a non-voting member this time around for this year on the board, but it is his first trip here to the Asia Pac. So we're going to pick your brain on the U.S. economy and what the Fed is doing these days. Of course, the first question has to be about this EE policy that the Fed is still sticking to, which is exceptionally low interest rates for an extended period of time. And people want to know, Charles, I mean, how long is extended?
Oh, I've been pretty clear in responding to that question that to me, low rates for an extended period of time means 3 to 4 meetings. That's about 6 months. It does depend on the condition of the economy and inflation. That is, if things were to change quickly, this is a guideline. We would adjust more quickly than that. But given the state of the economy, the high unemployment rate, and contained inflation expectations, I think this will continue for some period of time, 6 months or so.
Yeah, even into 2011, possibly.
It could. We will be looking very carefully at the evolution of the economic recovery. I think the economy is recovering, and it will build through 2010, but the labor market will be challenged for quite an extended period of time. If inflation expectations remain contained and there's no outsized change, we could have accommodative policies beyond this year.
Okay, well, let's talk about the upcoming jobs figures then, because you, like other economists, are looking at the labor market, still seeing it pretty weak, considering we have unemployment still close to 10%. Right. We're expecting an addition of 184,000 jobs for those non-farm payrolls on this Friday. Some would say that's a nice turn around the corner. What do you think? That
would be welcome. 184,000 would be a huge improvement. We've been seeing negative numbers for so long. We'll need very strong numbers, 300,000 and more, to make a big dent in the unemployment rate. And at the end of this year, the unemployment rate's probably going to be 9.25 and probably 7 something at the end of next year. It's going to be a long time for it to come down. We'll need very strong numbers, like you're saying.
Okay, so what does that mean for the U.S. economic recovery? Because I talked to two noted economists last week, Martin Feldstein of Harvard and also UC Berkeley's Laura Tyson, and both of them seem to have, I would say, a pessimistic outlook on the U.S. economy. In fact, Tyson says we're going to have a below potential economic recovery. How do you see things playing out?
Oh, I think that's right, that growth will be much too low and it will be below potential growth rate. The gap between where we should be in terms of potential growth and where we are will remain very high, big gap for quite some period of time. One of the things that makes me very nervous is when I talk to business people, as I do before every FOMC meeting, they are very consistent in saying that they have right-sized their operations. They've cut their workforce by quite a lot. They have a lot of excess capacity, and they are saying that they're able to stick with their current production size in order to meet expanding demand. And if that's true, and I'm a little skeptical of that, I think they'll probably have to expand their workforce by more. But if that's true, that's going to be weak job growth for too long.
Yeah, and recently in the Fed statement, you were talking about the housing market, describing the housing market as flat and depressed. Right. I mean, that sounds like it's a pretty bad situation still for American homeowners and the housing market itself.
Construction growth is going to be very weak for quite some period of time. Housing starts at a very low level, and there's a lot of concern still about too many people in mortgages, that they're not going to be able to make the payments, the uncertainty associated with joblessness and income growth. That's going to challenge home building for quite a long period of time. But the arithmetic of this is very unusual. Even though it's at a low rate, if it starts to expand, that will add to GDP growth in a beneficial way. So even if it's really low, but it starts to grow, that would be welcome, and that would generate some additional job growth.
Okay, let me ask you about regulation, because right now we have the Fed's role in bank supervision, with Congress threatening to reduce that at this point, and then Senator Chris Dodd's new banking regulation reform bill saying that the Fed should get more oversight. For instance, there could be a consumer protection agency installed at the Fed, and the Fed could have the responsibility of winding down these too big to fail institutions. I mean, who do you think has it right? Does Senator Chris Dodd have it right that there should be an uber-Fed regulatory institution, or should Congress be ruling back the bank supervisory roles for the Fed?
I think it's important that the Federal Reserve maintain at least our current responsibilities in bank supervision. Some of the proposals have suggested that maybe we should only regulate bank holding companies above $50 billion in assets. I do worry that that means that we would only regulate institutions which arguably could be in the too big to fail range. I think we need to have a line of sight into all levels of banking institutions, medium-sized banks and also small-sized banks. So we understand the pressures that they are dealing with, and we design the appropriate supervisory response. It provides a lot of information for us and me as a monetary policymaker. When I go to Washington, I have a lot of good grassroots information about how banks are engaging in lending and what the challenges businesses might be facing. So I'm hopeful that that will continue. In terms of larger authority to resolve big financial institutions, somebody needs to do that. I think that in terms of resolution, perhaps the FDIC or another agency could do that. It's important that the Fed, with our expertise, be involved in understanding those risks so that we can help identify what needs to be addressed.
Identifying risks for consumers as well with this Consumer Protection Agency, basically looking at these mortgages, at possible hedge funds might be part of it.
Right. I think that the Federal Reserve in the last few years has improved dramatically our attention to those policies for consumer protection. I think the changes in credit card rules and other types of things have been very beneficial. We've learned a lot. There have been a lot of lessons to learn through this process, and I think that I'm confident that we can do a good job if we continue to have that authority.
Okay, Charles, thank you for stopping by our Bloomberg studios. That's Charles Evans, who's the Fed Bank Chicago president, again, a non-voting member this year on the board, and that's his take on the U.S. economy.